Hello and welcome. Today we'll talk about accounting basics. We'll discuss what is accounting, accounting process, what are the assets, expenses, liabilities, equity, revenue. Then we'll discuss about double entry, debit, credit, and balance. All these points we will discuss in this video with detailed manner. So first we need to understand that what is accounting exactly. See, in a company there are many financial transactions are happening. For example, a company purchase the goods, then a company sell the goods. All these financial transactions need to be recorded first, then classify, then summarize the financial data into the meaningful format. Why we call meaningful format, and how is the a simple definition of accounting. See, we can simply define the accounting is summarizing the financial data into the meaningful format. For example, all those financial data that we have in a business, we first recording the data, then we classifying the data, then we summarizing those financial data into the meaningful format, because the shareholder of the company or the stakeholder of the company need to understand that what is the financial position of the company and what is the financial performance of the company. So from these financial data that we are making in meaningful format, we make one balance sheet. That what is balance sheet of the company? The balance sheet shows as the financial position of the company. Then from these data we make profit and loss account. Profit and loss account shows the financial performance of the company, that how this company is running and how this company is working, whether this company is on loss or profit. So we'll discuss all these points later on. So we discuss about accounting, that accounting is summarizing the financial data into the meaningful format. Then we need to talk about accounting process. What is the accounting process? See, it is a source document, journal entry, ledger, trial balance. Then we make financial statement. So first we need to understand that what is source document. Any transaction are happening in a business, so that should be based on the evidence. Those evidence can be invoice, can be bill, can be voucher, anything that we are recording, it's known as a source document. Then from source document we are journalizing the entry in a journal book. We need to journalize all those source document, all those transactions that happen in a business in a journal entry, that we will discuss later on, that what is journal entry, how it works, and how we are journalizing those step by step. Then from journal entry we are creating ledgers. It's also known as a posting. These we will make many ledgers. From all those ledgers there will be balances, and we from the balances will make trial balance as well. Then at the end we need to make financial statement, that can be a profit and loss account, balance sheet, cash flow statement, and as well a statement of changes in equity. That in this video we would only discuss these two important points, that what is profit and loss account and balance sheet from the financial statement. These we need to discuss. So this source document, journal entry, ledger posting, trial balance is known as a bookkeeping. A simple accountant can do all these stuffs. Then there are later on that we will discuss. So we discussed what is accounting process. Now we're coming to the 5 element of the financial statement. See, there is only 5 elements in a financial statement, not 6 elements or not more than that. One is assets, liability, equity, and expenses, revenue. These are the 5 elements of the financial statement, because it shows or represent the financial statements. We'll discuss later on step by step that what is exactly assets, liabilities, equities, expenses, or revenue. Now we'll just tell you that these two, revenue or expenses, will show in a PL account, profit or loss account, and as well these 3 points, equity, liability, and assets, will come in a balance sheet. So we talked about the 5 elements of the financial statement, that is assets, liability, equity, expenses, revenue. So now we need to understand these points step by step. So first is the asset. What is assets? An asset is a resource controlled by an entity as a result of past events, and from which future economic benefits are expected to flow to the entity. So what exactly control here mean? The control here means ownership. For example, in a company you are having machinery. You are having machinery in a company, you're utilizing those machinery, and future benefits are expected from that machinery. So that's known as a asset simply is a resource controlled by an entity, or a resource controlled by the ownership of the company. Then from the result of those resources or utilizing of those resources, the future benefits are expected to come from that. So it's known as a as asset. It can be machinery, it can be land, building, anything you're having in a business, that's known as a asset. We talked about assets. Now we need to explain the expenses. An expense is the cost of operation that a company incurs to generate revenue and from which no further benefit is expected. An expense in a company is simply the cost of the operation that a company incurs to generate the revenue. Generate revenue from that which no further benefit is expected. See, the difference between asset and expense is this. In asset, there is future benefit or expected, but in expense, there is no future benefit or expected from this. It is a cost of operation which incurs to in order to generate the revenue. So it can be the rent. For example, one time you give the rent and that's it. You're not expecting they will give you the rent back. Or there might be electricity because you consume the electricity, you need to pay the bill for that. So that is known as a expense, because this electricity will help you in your operation, then you will generate the revenue. It's known as a expenses. It can be salaries, etc., or anything. So now we need to talk about the liabilities. What is liability? Is a present obligation of the entity to transfer an economic resource as a result of the past events. So what is this liability? Is a present obligation of a company. For example, a company purchase goods worth 10,000. Worth 10,000 the product the company purchased, but the amount of money that's supposed to pay the company is remaining. So that is an obligation for the company that company will pay in future. So it is a present obligation for a company of the entity to transfer an economic resource. This economic resource can be goods or anything here as a result of the past event, this action done in the past. And past they bought the goods worth 10,000, but the amount to pay is remaining, so they will pay in future. It's known as a obligation, or it's called liability. It is a claim of outsider on total asset of the company. For example, those people that a company bought or purchased product from them were 10,000, they can claim on a company in total asset of the company that you need to pay all those amount of the goods that you have purchased from us. Simply is a present obligation of the entity to transfer an economic resource as a result of the past event. So we discussed assets, liability, and as well expenses. Now we'll talk about the equity or capital. So why it's called capital? Because capital is in a small company or small proprietorship company, an owner of the company, or the one who is investing in a company bring the capital into the business, or the amount that he is investing, it's known as a capital. But here equity means, for example, in a company there are thousands of owners. All those companies, they are bringing whatever they're having to the company, that's known as equity. They're bringing their capital to the company, that's known as a capital as well equity. So the technical definition here is it is the residual interest in the total assets of the entity after deducting all its liability, and as well it is the claim of owner in the total assets. We discussed in the liabilities that it was the or claim of the outsiders in a business, but here it's the claim of the owners in the total assets of the company. It's known as a equity. Discussed assets, liability, equity, expenses, and revenue. Now we'll talk about what is revenue. So it is the gross inflow of the cash receivable or other consideration arising in the course of the ordinary activities of business, such as sale of good, rendering of services. See, in a business or a company, you want to sell your finished goods. Whatever you're receiving from the finished good, or the amount of received from the finished good, is known as a revenue. It's sale of goods or rendering services. So here we'll talk about the double entry. What is double entry? See, in double entry there is two important points. One is debit and the other is credit. These debit and credits, they are just the effects of the transaction or event on the entity financial of statement. These are just representing the effects there. So the definition here is accounting attempt to record both effects of transaction or event on the entities of financial statements. So here, these effects just shows that every transaction has two effects. One is debit, another is credit. It represents the duality principle or dual aspect that later on we will discuss in detail, that what is debit or credit, how it is debit or how it is credit. So now we'll talk about the five elements: financial statements, the assets, liability, equity, and expenses, or revenue balances. So the balances here are written that assets, expenses, liability, equity or capital, revenue or income. See, listen, this is a very important point here we need to discuss. Asset is the balance of asset is always debit. We're writing debit with DR, and the expenses as well always debit. See, when assets increase in a business, so it's written down as a debit. On when asset decrease in a business, it's written down as a credit. But the balance of asset is always debit. And the balance of expenses also debit. When it's increased, it's debit, and when it's decreased, it is credit. Then we come to the liability. Liability or the obligation of the company. Liability, the balance is credit, and if it is increased in a business or a company, it's credit. If it's decreased, it is debit. And as well, equity or capital, the balance of that is credit, or when it is increased, it is credit, or when it is decreased, it is debit. Then revenue or income in the company, the balance of that is credit. When it's increased, it can be credit, and as well when it is decreased, it is debit. So these are the rules for that, and it's not changing for that. So these are the balance of this point that we discussed here. So we discussed so many things in this video. We have discussed what is accounting, we discussed the process of accounting, we discussed what is the assets, the expenses, liabilities, equity, and revenue. Then we have discussed double entry, we discussed debit, credit, and balances. In coming video, we will work on practicals of this, and we'll solve the problem of it. Thank you.